Welcome to the Explainer. Today we are cracking the code on a really important piece of paperwork for Americans living abroad, IRS Form 8938. What is it? And maybe more importantly, do you actually need to file it?
This is a question that trips up so many US expats, and getting it wrong can be surprisingly costly. So let's break down the rules and figure this out.
So here's what we're going to cover. We'll start with what the form is all about. Then we'll get into who needs to file it and the specific money thresholds that matter. After that, we'll dive into the tricky part, how to value your assets. We'll also see how this is different from the FBAR. And finally, what happens if you don't comply? Let's jump in.
Okay, first things first, let's set the stage. This form, Form 8938, it's a direct result of a law called the Foreign Account Tax Compliance Act, or as you'll often hear it, FATCA.
See, most tax forms, they're all about your income, right? Well, this one is a different beast altogether. Its only job is to give the IRS a clear picture of your foreign financial assets. The core mechanism here isn't about calculating tax. It's simply about disclosure. Transparency. That's the key. So who exactly does the IRS consider a specified individual? In other words, who has to worry about this? Well, the net is cast pretty wide, as you can see. It covers US citizens and most residents. But here's the absolute crucial point for expats. Just because you live abroad, that doesn't get you out of being a specified person. What living abroad does change are the dollar amounts that trigger the filing requirement, and that is a huge distinction. So how do you unlock those much higher reporting thresholds we're about to talk about? Well, you have to prove your connection to a foreign country. You're essentially showing the IRS, hey, my foreign assets are a normal part of my life abroad, not just money I've stashed offshore. All right, this is probably the part you've been waiting for, the numbers. For expats, the filing thresholds are dramatically higher than for folks living back in the States. Now, you have to pay super close attention to this table. The most important mechanism to understand is the dual trigger system. It's not just one number. You have to file if your assets are over the limit on the very last day of the year, or if they cross an even higher limit at any point during the year. That is so critical. It means you could have sold a big foreign asset in, say, July. And even if your year-end balance is way below the first threshold, you could still be on the hook to file. And that number, $600,000, really tells you the whole story, doesn't it? We're not talking about a small checking account. These rules are designed to get information on people with really substantial foreign holdings. Okay, knowing the thresholds is step one. Step two is actually figuring out the value of your assets. And believe me, this is where a lot of people make mistakes because of some non-obvious details. When the IRS says specified foreign financial assets, they're not just talking about your bank account. The definition is incredibly broad. It can mean stocks in foreign companies, an interest you might have in a foreign partnership, even some types of foreign pension plans. The common thread here is that it's an investment type asset based outside the US. Okay, buckle up, because this is probably the single most confusing part of this whole process, especially for married couples who file their taxes separately. There's a really quirky two-step logic you have to follow. First, just to see if you even need to file, you only count half the value of an asset you own jointly. But, and here's the catch, if that calculation puts you over the filing threshold, you then have to report the full 100% value of that joint asset on your form. It's a weird little rule that's so easy to miss. And don't just take my word for it. The official IRS instructions lay out this exact, kind of weird scenario. They show how a couple can jointly own an asset that's worth more than the individual threshold. But because they each only have to count half for the test, neither of them actually has to file. It's a perfect example of just how specific these rules are. All right, let's tackle another huge point of confusion. Form 8938 versus another form you might have heard of called the FBAR. People mix these up all the time, but it is vital to know they are completely different things. Look at this table. The biggest takeaway? Different agencies, different missions. The FBAR is for FinCEN, the Financial Crimes Enforcement Network. It's about anti-money laundering. Form 8938 is for the IRS, and it's about tax compliance. That's the whole ballgame. It's also why you might end up needing to file both, or just one, or maybe neither. And finally, let's talk about the consequences. What's the cause and effect relationship here? What happens if you get this wrong? This is so important to understand. The penalty isn't for owing tax on the asset. It's for the failure to file the form itself. The IRS considers the lack of disclosure a serious offense all on its own, which just drives on the point that this form is all about providing information. The penalties start high and can climb dramatically if you don't file after you've been notified. We're talking about tens of thousands of dollars, which just shows how seriously the IRS takes this reporting requirement. So, as you think about your own situation, what are the big mechanisms to remember? This form is about assets, not income. You have to watch out for that dual trigger threshold and be really careful with those quirky valuation rules for joint assets. Getting those non-obvious details right is absolutely the key to staying compliant while you're living and working abroad.